In today's dynamic business landscape, we are going to discuss the intricacies of capital conquests. Strategies for corporate growth. First on our agenda, financial forecasting and planning. In the corporate world, flying blind is not an option. Financial forecasting and planning are your navigation tools, helping you chart a course through the turbulent waters of the business world. Financial forecasting is the art and science of predicting your company's financial future. It's not about crystal balls or tarot cards. It's about leveraging historical data, current market conditions, and future projections to create a realistic picture of what lies ahead. For instance, if you're in the retail sector, you might forecast increased sales during holiday seasons or predict a downturn if economic indicators suggest a recession. This foresight allows you to prepare for both opportunities and challenges. Planning, on the other hand, is about taking that forecast and developing strategies to capitalize on it. If your forecast shows a potential market expansion, your plan might include strategies for scaling up production or entering new markets. Conversely, if you foresee a downturn, your plan might focus on cost-cutting measures or diversifying your product line. The synergy between forecasting and planning creates a powerful tool for proactive management. Instead of reacting to market changes, you're anticipating them and positioning your company to thrive regardless of the circumstances. Performance metrics and benchmarks. In the realm of corporate finance, what gets measured gets managed. Performance metrics are the vital signs of your business, providing crucial insights into your company's financial health. Key performance indicators might include 1. Return on investment. This measures the profitability of your investments. A higher ROI indicates more efficient use of capital. 2. Earnings before interest, taxes, depreciation, and amortization. This provides a clear view of your company's operational performance without the influence of financial and accounting decisions. 3. Net profit margin. This shows what percentage of your revenue becomes profit after all expenses are accounted for. A higher margin indicates better cost management and pricing strategies. 4. Debt-to-equity ratio. This measures your company's financial leverage. A high ratio might indicate higher risk, but also potentially higher returns. 5. Current ratio. This assesses your company's ability to pay short-term obligations. A ratio below 1 might signal liquidity issues. However, these metrics don't exist in a vacuum. That's where benchmarking comes into play. Benchmarking involves comparing your performance metrics against industry standards or competitors. It provides context to your numbers and helps identify areas for improvement. For example, if your net profit margin is 10%, that might seem satisfactory. But if the industry average is 15%, you know there's room for improvement. Conversely, if the industry average is 7%, you're outperforming your peers. Benchmarking isn't about keeping up with the Joneses, it's about setting realistic yet ambitious goals for your organization. It helps you identify best practices in your industry and adapt them to your unique circumstances. The role of big data and analytics in modern financial analysis. In today's digital age, data is the new oil. The sheer volume of information available to businesses is staggering. But raw data is just noise without the right tools to interpret it. That's where analytics comes in. Big data and analytics have revolutionized financial analysis. They allow you to identify patterns and trends that might be invisible to the naked eye. Make more accurate forecasts based on comprehensive historical data. Segment customers more effectively for targeted marketing and product development. Optimize pricing strategies based on real-time market data. Detecting and preventing fraud more efficiently. For example, a multinational corporation might use big data analytics to optimize its global supply chain, analyzing factors like weather patterns, political stability, and currency fluctuations to make real-time adjustments and minimize disruptions. However, it's crucial to remember that data and analytics tools are only as good as the people using them. You need skilled analysts who can ask the right questions, interpret the results, and translate data into actionable business strategies. Moreover, with great data comes great responsibility. As you harness the power of big data, it's essential to prioritize data security and privacy. Compliance with regulations like GDPR is not just a legal necessity, but a business imperative in building trust with your customers and stakeholders. Scenario planning and stress testing. In an increasingly volatile business environment, the ability to anticipate and prepare for various futures is invaluable. This is where scenario planning and stress testing come into play. Scenario planning involves developing detailed plans for multiple potential future scenarios. It's not about predicting the future with certainty, but about being prepared for a range of possibilities. For instance, a technology company might develop scenarios for rapid adoption of their new product, slower than expected market penetration, the emergence of a disruptive competitor, changes in regulatory environment. By thinking through these scenarios in advance, the company can develop contingency plans and respond more quickly and effectively when changes occur. Stress testing, on the other hand, is about pushing your financial models to the limit to identify vulnerabilities. It's like crash testing a car. You're intentionally simulating extreme conditions to ensure your business can withstand shocks. Typical stress tests might include a severe economic downturn, loss of a major customer or supplier, significant changes in exchange rates or interest rates, cyber attacks, or data breaches. The goal isn't to be pessimistic, but to be prepared. By identifying potential weaknesses in advance, you can take steps to mitigate risks and build a more resilient organization. Strategic financial decision-making. This is where the rubber meets the road. Strategic financial decision-making is about leveraging all the insights from your forecasting, metrics, analytics, and scenario planning to make informed choices that shape your company's future. These decisions include major capital investments, mergers and acquisitions, entry into new markets, changes in capital structure, dividend policy adjustments. The key to effective strategic financial decision-making is balancing quantitative analysis with qualitative factors. While the numbers are crucial, they don't tell the whole story. You also need to consider factors like long-term strategic fit, corporate culture and values, stakeholder expectations, regulatory environment, technological trends. For example, when considering an acquisition, you'd naturally look at financial metrics like the target company's profitability and growth potential. But you'd also need to consider how well their corporate culture aligns with yours, potential synergies, and the regulatory landscape of entering a new market. It's also crucial to involve the right stakeholders in the decision-making process. While the CFO and finance team will naturally play a central role, input from operations, marketing, HR, and other departments can provide valuable perspectives and increase buy-in for the final decision. Remember, strategic financial decisions often involve trade-offs. Investing in long-term growth might mean sacrificing short-term profits. Maintaining a conservative capital structure might mean passing up potentially lucrative opportunities. There's rarely a perfect solution, but by leveraging all the tools we've discussed, forecasting, metrics, analytics, and scenario planning, you can make more informed decisions and increase your chances of success. In conclusion, mastering financial analysis and planning is not just about crunching numbers. It's about developing a holistic understanding of your business and its place in the broader economic landscape. It's about using data to tell a story about your company's past, present, and potential futures. And most importantly, it's about using that story to make decisions that drive your business forward. As you implement these strategies, remember that financial analysis and planning are not one-time exercises. They should be ongoing processes, continuously refined and updated as your business evolves and market conditions change. To succeed in corporate finance, combine data analysis with human judgment, stay curious, and continuously learn. Master these concepts and techniques to shape your company's future and drive sustainable growth.